Hi traders! In this video, I'll show you the best strategies you can use to profit in a sideways market. First, it's important to understand that in the world of technical analysis, there are two types of markets, trending and sideways. Trending markets are those where the price moves in a certain direction. If it's going up, that's called an uptrend. If the price is falling, that's called a downtrend. I'll show you great strategies you can use to profit in a sideways market, because that's where the price spends most of its time. First, we need to learn how to recognize sideways movement. It's easy to spot once it forms. However, there are situations when you can identify its formation in advance. For that, you need to understand the local market structure. Let me explain with an example. We see that the market was initially in an uptrend, since each time new highs and lows were being formed. That's why we classify this movement as an uptrend. Now pay attention to what happens next. The price rises and then falls again, but this time it fails to hold above the previous high. After that, the price tries again to update the high and low, but then corrects, forming sideways movement. Now let's look at another example. Here, we see that the price was originally in a clear downtrend, forming lower highs and lower lows. Then we see another drop, but this time the price can't fully move lower because of a bullish engulfing pattern, which causes it to bounce back sharply. From this, we can clearly see that the market structure has already changed. It has shifted from a downtrend to a sideways market. Now that we've identified this transition, the next step is to mark the key levels, the support and resistance levels. There are a few reasons why we draw horizontal levels. The first reason is to define the area where the price is still fluctuating and hasn't broken out. This tells us that the market continues to trade sideways and hasn't changed yet. The second reason is that we define the trading zone that we'll use for our strategy. Now that we've marked the key levels, we'll look for entry points by watching the price bounce off these levels. Here, you'll become a trader who makes money. And remember, if you want these trades to bring real profit, not just pocket change, it's simple. 4% a month on $1,000 is $40. 4% a month on $100,000 is $4,000. You're not chasing huge returns, you need more capital. That's why I work with HashHedge, a prop trading company that lets you trade with their money, not yours. You pass a simple test, prove your discipline, and get access to an account from $5,000 to $100,000. Risks are controlled automatically. You can't blow the account. The system won't let you. This is the discipline many lack. So, if you want to trade strategies like this with real capital, try HashHedge. Link in the description. It's simple. We see that the price was first in a small uptrend, and then a sideways movement formed because the highs and lows stopped updating. We draw resistance and support levels. As you can see, the price reacts every time it touches these levels, and that's what we'll take advantage of. But keep in mind, sometimes the price reverses even before reaching the key levels. Like in these cases. Although earlier the price reacted perfectly to level touches, bouncing every time, now it reverses even before reaching them. You may also encounter a tight range, where the distance between the upper and lower level is very small. As a result, the price has very little room to move, which can lead to sudden breakouts, making it hard to trade using the bounce strategy from key levels. That's why the best way to trade such markets is by using a breakout strategy. As we mentioned earlier, when the market moves within a certain range, it indicates price consolidation, which is usually followed by a breakout. Here's how it works correctly. Step 1. Find a narrow range where you can work. Next, mark the key levels. But remember, don't place them too close to each other. Focus on the true highs and lows. The next step is to determine the breakout direction. Keep in mind that in a tight market, false breakouts can happen quite often. So here's a simple trick to avoid that. You need to wait for confirmation. For example, a strong impulse candle breaking through the key level. That's where we open a short position. The same logic applies to long positions. Find a narrow range and mark the key levels. Remember, it's important to wait for a full confirmation above the level before entering, so you don't open a trade on a false breakout. A strong breakout with a big green candle is a good sign that the move is likely to continue upward. You can also look for other candlestick patterns or divergences for additional confirmation. On the chart, we can see a hidden bullish divergence on the RSI indicator and rising volume at the moment of the breakout. We confidently open a long position. If this video was helpful, please like it and let me know in the comments which strategy topic to cover next. See you in the next video.